Welcome back to Investing Talk podcast. Today, we're doing a deep dive into UiPath. You send us information covering their recent performance, financial health, and future outlook. And our mission is to unpack what's most important for you to understand. We have analyst ratings, recent news about acquisitions and partnerships, and a detailed due diligence report. Quite a stack. Okay, let's unpack this and figure out what stands out.
It certainly is a comprehensive set of information you've provided. What's fascinating right off the bat is the duality we see in UiPath's current situation, strong underlying business with some clear market headwinds.
For anyone who might be less familiar, can you give us a quick overview of what UiPath does?
Okay. UiPath is an enterprise automation and AI software company. Their main focus, historically anyway, has been in robotic process automation, or RPA. Think of it as software that can automate repetitive tasks, kind of mimicking human actions to improve efficiency.
So it's like giving digital workers to companies to handle the boring stuff.
In essence, yes. But it's evolved beyond just simple task automation now. UiPath offers an end-to-end platform. This integrates artificial intelligence, machine learning, and natural language processing. This allows for the automation of more complex workflows, things that require understanding documents or even making basic decisions.
And what are some of their key products? Like what tools do they actually offer?
Well, they have the software robots, which are sort of the core of the RPA side. Then there are AI-driven tools for things like automatically processing documents and, extracting information, understanding content. They also provide workflow management tools to orchestrate all these automations. And what's quite strategic is that their platform is designed to be modular. So a company can start small, maybe automate a few simple tasks, and then scale up across the entire organization.
That makes sense. Start small and grow. Now, looking at their recent performance, it seems like it's been a bit of a roller coaster, especially lately.
That's a very apt description. Over the past month, we saw a pretty significant drop in their stock price, almost 16%, right after their Q4 fiscal year 2025 earnings report. And this happened even though they actually beat expectations for their earnings per share.
That's always a head scratcher. You
Yeah.
beat expectations, usually sends the stock up, but it went the other way. What was behind that?
The sources suggest a couple of factors. Firstly, while the EPS was positive, there might have been concerns about other parts of the report. Maybe future guidance or the pace of revenue growth wasn't quite what the market wanted. Secondly, there's the broader context. The stock's been under pressure for the last 6 months or so. This seems tied to general market uncertainties and, importantly, specific worries about how well UiPath is navigating this transition towards more AI-driven solutions.
Right. So it feels like the market's reaction, even with the EPS beat, highlights this big shift in focus. A positive bottom line is good, sure, but the real concern seems to be about future growth in the age of AI. Investors are asking, is UiPath's core RPA business still strong enough for expansion? Or is this AI transition going to be, really bumpy?
That's a key point. And if we zoom out even further, the fact that the stock has declined by over 50% in the past year, well, that really underscores these investor concerns and the challenges of this tech shift. It's a stark reminder of how dynamic investing in tech can be.
Absolutely. Now, let's dig into the financial health a bit more. What do the numbers tell us? The foundation that supports this AI transition.
Looking at the financials, for Q4 of fiscal year 2025, they reported revenue of $424 million. That's a 5% increase compared to the same quarter last year. Their full-year revenue hit $1.43 billion, which is a respectable 9% increase.
Okay, so top-line growth is still happening.
Yes.
Maybe not explosive, but it's there. What about profitability?
Well, over the trailing 12 months, they did report a net loss of about $73.7 million. However, like you mentioned, in that recent Q4, their earnings per share actually came in at $0.26. That was significantly higher than the $1.20 analysts were forecasting.
So they're still in the red overall for the year, but they managed to beat profit expectations last quarter. That's definitely something, a potential turning point maybe.
It could be read that way. It certainly suggests they might be gaining some leverage or managing costs effectively, at least in the short term. Another really positive sign in their financial health is their very low debt-to-equity ratio. It's just 0.044.
Wow, okay.
Which indicates a strong financial foundation and a pretty conservative approach to debt. That's always reassuring.
Definitely good to see a healthy balance sheet. What about their ability to actually generate cash? Cash flow is always key.
Right. In fiscal year 2025, their net cash flow from operations was $321 million, and their non-GAAP adjusted free cash flow was $328 million. These are strong figures. They show their ability to generate significant cash from their core business. This adjusted figure kind of gives a clearer picture of the ongoing cash power.
So despite that net loss on the books, they're bringing in a lot of cash. This gives them flexibility, right, for R&D, acquisitions, weathering storms.
Precisely. That cash cushion is a significant strength. Now, it's important we balance this positive picture with some of the red flags that have been identified in the sources.
Right, because it's never all just good news. What are the main concerns being raised?
The big ones are, well, this challenge of transitioning effectively to AI-driven solutions. The market's clearly looking that way. There are also broader macroeconomic uncertainties, particularly highlighted in the U.S. public sector, which could slow down deal flow. And of course, the automation and AI space is just getting more and more competitive.
So it's a race to innovate and adapt, while also dealing with potential economic headwinds. On the flip side, what are their key strengths? What helps them fight back?
As we've touched on, their strong financial position, that significant cash reserve, is a major asset. Their platform is also designed to be scalable, which is really attractive to large enterprises. And their strategic acquisitions, the purchase of Peak AI, is a prime example, show they're actively working to enhance their AI capabilities.
That Peak AI acquisition keeps coming up. Can you tell us more about the significance of that one?
Peak AI is described as an AI-native agentic application company. Think of agentic as moving beyond just pre-programmed steps. Instead of mimicking clicks, these systems can learn, adapt, maybe even proactively suggest or initiate actions based on context. It's a pretty significant leap in how intelligent automation can be. By acquiring Peak AI, UiPath is aiming to seriously bolster its vertical AI solutions, specifically targeting sectors like retail and manufacturing. It's a clear signal about where they want to lead next.
Okay, so they're definitely not sitting still. They're actively trying to tackle that AI transition challenge head on with buys like that. Now, what's the general feeling out there? What are analysts saying? Public opinion.
The average analyst rating, based on the info you sent, is currently a hold. Their 12-month price target does suggest some potential upside from where the stock is now. This hold rating likely reflects that balance we've been talking about, potential versus ongoing challenges. Public opinion seems pretty mixed. There's definitely excitement about the potential of UiPath's AI moves, but that's kind of tempered by concerns over the recent stock performance and, how smooth this transition will actually be.
Makes sense. Cautious optimism, perhaps. Now, you mentioned the competitive landscape getting tougher. Who are the big players they're really going up against?
In the traditional RPA market, you've got companies like Automation Anywhere and Blue Prism as key competitors. But the field is evolving fast. They're also facing competition from newer emerging AI technologies that can handle some similar tasks, and sometimes even more complex ones.
So it's not just about RPA anymore. It's the broader intelligent automation space. How is UiPath trying to stay ahead in this tougher arena?
Their strategy seems to be kind of two-pronged. Firstly, they're focusing on innovation, particularly in this area of agentic automation we just discussed, trying to create a more advanced AI-powered RPA. Secondly, they're making those strategic acquisitions like Peak AI to quickly bring in new tech and expertise. And that recent AI partnership with Google Cloud, focusing on transforming medical processes, that also highlights their efforts to expand into specific sectors and leverage cloud AI power.
That Google Cloud partnership in healthcare sounds pretty significant. What's the potential there?
Well, the healthcare industry has a huge number of complex, often repetitive processes just ripe for automation. Think about patient data management, claims processing, even appointment scheduling, the list is long. By partnering with a major player like Google, UiPath gets access to their powerful AI infrastructure and, frankly, a much broader reach within that whole healthcare ecosystem. It could be a very lucrative area for them.
Okay, so we've looked at the past and present. Given this increasingly competitive world, what are the key things we should be looking for, like signals of their future success?
Well, the launch of their new AI products, particularly things like the Agentic Testing solutions they've mentioned, that'll be a key indicator. How well are they executing on this AI shift? The successful integration of Peak AI's technology and team will also be crucial to watch. And of course, we need to keep an eye on those risks, the macro conditions, any potential delays in those big public sector contracts.
Right, so execution on the AI strategy and navigating the economy are the main things. Let's just touch on some specific recent developments. That earnings report on March 12th seems important.
Absolutely. As we discussed, $424 million in revenue for Q4, a 5% year-over-year increase. But maybe more importantly, their annual recurring revenue, ARR, that's key for subscription businesses, hit $1.666 billion. That showed a healthy 14% year-over-year growth. That ARR figure is often seen as a strong indicator of future revenue stability.
So while the overall revenue growth was maybe more modest, the recurring revenue is growing faster. That suggests increasing customer stickiness, maybe.
It does. It implies they're not only getting new customers, but also keeping and expanding business with existing ones. That leads to a more predictable revenue stream. Then you have the peak AI acquisition. Enhancing AI specifically for retail and manufacturing, that really stands out strategically. And the Google Cloud partnership, announced in early April, targeting healthcare, another significant development, possibly opening new growth avenues.
It feels like they're making very targeted moves to strengthen AI and push into key industries. What about the stock price itself? As of early April, it was around $11.08.
Yes, that's the figure mentioned. And it's interesting, there was actually a nearly 5% jump in the stock price just before that earnings report, suggesting maybe some positive anticipation. But as we know, the reaction after the earnings came out was quite different.
Right, highlighting the market's perhaps more nuanced view, looking beyond just the headline numbers. Let's zoom out a bit. Look at the bigger picture. How is the whole RPA market evolving with AI?
The RPA market is definitely at an inflection point. With AI progressing so rapidly, traditional rule-based RPA is starting to be, well, complemented and, in some cases, challenged by more intelligent automation. That's why companies like UiPath are aggressively integrating AI, machine learning, etc., into their platforms. They have to evolve from just automating clicks to automating more complex sort of cognitive tasks.
So it's like upgrading from basic robotic arms to something with more of a digital brain.
That's a pretty good analogy, yes. And we're seeing competitors also heavily investing in AI and automation. UiPath's focus on agentic automation, that more autonomous, intelligent agent approach, is one way they're trying to stand out. These strategic partnerships, like with Google Cloud, are another key part of that differentiation strategy, tapping into specialized AI and market access.
Now, you mentioned a recent drive in the stock price. We know it dipped after earnings. But what factors might have contributed to any upward movement before that, or maybe helped cushion the fall?
Well, the positive aspects of the earnings report itself, especially that revenue and strong ARR growth, likely provided some initial support or at least a sense of underlying strength. The strategic acquisitions like Peak AI and those high-profile partnerships like Google Cloud, they send a message. They show UiPath is actively innovating and looking towards future growth areas. This commitment to AI and expansion, aligning with broader industry trends, would naturally help bolster investor confidence, at least somewhat.
Okay, so positive news can give it a bump, but it seems sustained growth really hinges on executing that AI strategy and navigating those economic factors. Now, we have this detailed due diligence report here. Let's dive into some key takeaways from that closer look.
Okay. The report reiterates that full-year fiscal 2025 revenue of $1.43 billion, showing that 9.3% increase. Solid growth for their size. It also highlights the improvement in their loss per share down to $0.13 in fiscal 25 from 16 cents the year before. And importantly, that their EPS actually beat analyst estimates by a significant 32%. This trend towards profitability is definitely something investors will be watching very closely.
That EPS beat by 32% is a key data point, suggesting maybe they are on the right track towards turning a profit eventually. And the report mentions their debt levels again.
Yes, it reemphasizes that very low debt-to-equity ratio, 0.044, reinforcing their strong financial footing. And those strong free cash flow figures, $328 million non-GAAP adjusted, are also highlighted again. Shows they can generate cash.
What about their valuation? The report mentions a negative PE ratio. What does that tell us?
A negative price-to-earnings ratio simply reflects the fact that the company currently has a net loss, right? Earnings are negative. But it's important to remember the market is often forward-looking. A negative PE can sometimes indicate that investors still have expectations for the company to become profitable down the road. The stock price kind of reflects that anticipated future potential.
So the market hasn't totally given up on their potential to make money later on. What does the due diligence say about their competitive advantages?
It points to their innovative automation solutions, especially these newer AI-powered features, and their well-established brand name in the RPA market as key strengths. They're recognized as a leader, and they are continuously trying to push the boundaries of automation.
And in terms of market position, they're still seen as a leader despite all the new competition.
Yes, the report confirms their leadership position in the RPA market. However, it also repeats that while the increasing demand for automation and AI creates big growth opportunities, that competition from emerging AI tech is a very real risk they need to keep addressing.
What about the people running the show? Anything in the due diligence about management?
It notes the long track record of the founder and CEO, Daniel Dines, and the COO CFO, Ashim Gupta. Their experience and tenure likely provide, a degree of stability and strategic direction.
But the report also mentioned something about insider stock sales. That can sometimes make investors nervous.
That's true. The report does note recent insider stock sales as a potentially bearish signal. It's something for you and all investors to be aware of and consider in the overall context. There can be various reasons for insider sales, not all negative, but it's definitely a data point.
Okay, and for income investors, UiPath doesn't currently pay dividends?
That's correct. They're currently focused on reinvesting earnings back into the business for growth and innovation rather than paying out dividends.
Finally, what are some of the major risk factors UiPath themselves highlight in their official SEC filings?
The report points to competition, which we've talked a lot about, global economic uncertainty, and potential changes in regulations affecting the automation industry as key risks identified by the company itself.
So summing up the due diligence, it paints this picture of a company with strong fundamentals, a leading spot in a growing market, clear focus on AI innovation, but definitely not without challenges. Competition, economy, tech shifts.
Exactly. It feels like the next year or two will be pretty crucial in seeing how they navigate all that. The Peak AI merger is definitely highlighted as a significant recent move supporting their strategy, and importantly, no major scandals affecting the stock were noted.
So looking at all your sources, you can see UiPath is in a really interesting position. They're a leader, yes, but in a market that's changing fast. They're making these strategic moves in AI, and while there are definitely some headwinds and volatility, their financial health appears pretty solid underneath it all. The acquisition of Peak AI and that Google Cloud partnership particularly signal their commitment to the future of automation. This raises an important question for you, the listener. How will their established RPA leadership play out as AI continues to evolve and, frankly, disrupt this market? It's definitely something to continue watching. Thanks for sharing your sources. We hope this deep dive has given you a clearer picture. Remember to subscribe, like, and comment if you found this helpful and want us to unpack more topics for you.